Until February 1st, we are putting on sale our brand new video series product, the Asymmetrical Iron Condor by Amy Meisner. The Asymmetrical Iron Condor is a brilliantly designed strategy that has virtually no upside risk and is very, very resilient to the downside. It takes a lot of the angst that comes up in Iron Condor trading out of the trade through the unique trade design of the Asymmetrical Iron Condor. To take advantage of this special offer and the special discount that we're offering on this strategy until February 1st, go to smbu.com/AIC. So today I'd like to talk about what we call in the trading world binary events, which are an event where it can come out either one way or the other. There's no in between, and the world is expecting a pretty large market reaction to whichever way it goes. In 2016, we had a number of those. Those of you who traded through 2016 will quickly know what I'm talking about. There was the British referendum on exiting the EU, which happened in the summer, in June, and the other major one, which happened this year, of course, was the U.S. presidential election, which happened in, of course, November. And the market did not disappoint. There was a big market reaction to both, although I would say the market reaction was probably a surprise to those who were predicting how the market would react. It was a surprise in both cases. There was initially a sell-off in both cases. In the case of the Brexit, that sell-off lasted for a couple days, and then the market rallied very, very strongly, which was unexpected. And then the second event was the Trump victory, and at that time, of course, the market sold off heavily overnight, and by the end of the next day, the U.S. market opened, I guess, down a little bit, and then ultimately rallied, and then had a very, very dramatic rally over the next several weeks. So, a couple lessons to draw from that. One is, oftentimes, if all the experts predict a big market reaction, there's usually a big market reaction. That's actually important information. It's not always true, by the way. There's not always a large market reaction to a binary event, but there usually is. You can pretty much count on that. But the direction of that move, I would say the talking heads, as often as not, get wrong. And so you can't know what the reaction is going to be. No one expected a big rally after Brexit. No one expected a big rally after the Trump victory, but that's what we got, and we got it in a big way. So if you're a market neutral options trader, you have to realize that the talking heads are often wrong, and if you base your decisions on the talking heads, then you may be disappointed often. There are other binary events which occur in other spheres. They're not just elections or referendums. You can also have it as a result, a binary event as a result of a major market report, such as an employment report or a crucial Fed announcement where there's going to be a decision as to whether there will be a rate increase or not a rate increase, a reduction in quantitative easing or not a reduction in quantitative easing, etc. So those could also be seen as binary events. There is some very common market patterns which occur right before a binary event, and the first one is that there will be information coming out right leading up to that binary event. In the event of elections, for example, you'd have polls coming out. You'd have major speeches or debates where people interpret it as one side, one or the other. And then there's a reaction to that. So leading up to the binary event are sort of mini binary events. If a poll comes out saying one particular candidate's way ahead, the market will react to that, almost as though the election occurred when in fact it was just a poll. Or someone wins a debate, then the market will react like the election took place. So there's sort of these mini reactions which occur beforehand, and you need to be aware of that. Secondly, very specific to the options world, is that options volatility starts to heat up coming into an election, which means that positions which are front month only positions, which are negative vega, meaning they respond negatively to increases in volatility, the value of those positions will come down leading into an election. And so if your decision involves changing your positions in some way as a reaction to the binary event coming up, you have to be aware that in a sense the market starts pricing in the movement of that binary event in the options market before it occurs. So we've got a professional options trading desk here at SMB Capital, and our traders are aware of these phenomena. And so what I've observed on our desk through both of these events, Brexit and the US presidential elections, is three basic reactions. The first reaction is nothing. Some traders do not believe in reacting to news at all. They believe the market's completely statistical, and therefore you cannot worry about an event. And sometimes that works out well, sometimes it does not work out well. The second reaction is the opposite, which is some traders take all of their trades off or greatly reduce their capital right before a binary event. When I look back over my trading career, I would say if timed correctly, it's probably actually a pretty good idea to take the trades off going into the binary event, but I could be disproven on that. My kind of anecdotal observations are that in fact it probably would not have been a bad idea over time to have just taken the trades off and waited out that event. But there is another approach that some traders take, which is not to necessarily keep their front month positions open, but rather close those and roll them into a back month as volatility increases. In other words, let's say the event is going to occur in 10 days. You may take your position off now, wait for the inevitable increase in market volatility to occur, and then either put the position back on or put the position back on in a later month. And the reason you'd want to use the later month is because gamma is lower, meaning that the market will, whatever the market reaction is, it will affect the value of the position less. And also, because options volatility is up, you will get a better price for it. And so therefore, one of the more clever traders on our desk did exactly that. She took her positions off right before the US presidential elections and moved them into a back month. And the prices for the back month were terrific because the timing of that move was to first exit during the lower volatility period and then enter the back month during the higher volatility period, getting the advantage of both having the position in the low gamma back month as well as the lower prices, which came about as a result of the increase in options volatility. So in summary, there's lots of different ways of handling a binary event, but you don't have to just sit there. You can, and you may do fine. There's no guarantee that the market will react in a strong way to a binary event. Sometimes the market just simply doesn't react that much at all. Typically, the bigger the binary event, the less likely that the market won't react. In other words, most of the time, if everybody thinks there's going to be a big reaction, there's probably going to be a big reaction. Whether the talking heads have the direction of that reaction right is very, very doubtful. But whether there will be a big reaction is probably more likely. So it's a good idea to at least think this through. If you're up a lot of money on a position and a binary event is coming up, it's probably a pretty good idea. Close it or at least take some of your profits because there's probably a very high probability there will be a big move and that will probably affect the profits of your position. But that doesn't stop you from getting in at an advantageous time, including before the binary event, if options volatility gets so pumped up that you have wonderful pricing opportunities, let's say in a back month like I mentioned. Now let's talk a little bit about after the binary event. Many of these events have what I call aftershocks, and that is the market sort of keeps reacting to the event. So let's take, for example, the US presidential election. After the market realized that Trump was going to win and that the Republicans would have control of both houses, and therefore maybe this isn't such a bad thing for the world economy. Maybe this is actually a great thing for the world economy if U.S. corporate tax rates come down and there's a lot of fiscal stimulation coming out of the federal government. Perhaps that would be very good for the world. Apparently that conclusion was reached sometime overnight, as the election unfolded. So there wasn't just one positive reaction to the election. There was weeks and weeks of positive reactions to the election. So if you're trading options market neutral positions after the election, you were undoubtedly strained to the upside. So what many solid traders do is they not only get out of harm's way before the big event, but they also wait until the aftershocks of the big event are over. And when they will end, is an unknown. But they're not going to end most likely 1 day later or 2 days later, particularly the more shocking the outcome of the event. It could be 4 or 5 or 6 trading days later. So just imagine if you were trading market neutral option strategies and you got in 5 or 6 days after the U.S. election instead of the day of the U.S. election, how much better off you would have been, how much less the market would have traveled away from the profit zone of your position. So it is a good idea to allow those aftershocks to occur. Now, will you know when those are over? Of course you can't know, but you might, on average, perhaps wait 3 to 5 days to get back in to pretty much reassure yourself that if there's going to continue to be a big move, it certainly won't be as far as maybe the first 3 to 5 days were. So that is a very good way to play a binary event. So to summarize, you can do nothing, you can get out completely and then get in after the aftershocks, or you can get out of your presumably profitable position that you did not want to expose to the binary event and get into a cheaper back month position that will respond less to market movement and of course is priced better, and therefore presumably you have a better shot at a better outcome. So that's what the pro traders on our desk did. They took various solutions to the issue, and I wanted to share those with you today because I feel like if you understand the way we trade on a professional desk, perhaps it can help you to make decisions on your own. So thanks very much, and we'll see you next week.